You're ready to buy a home, but there's one thing holding you back: debt. Should you wait until you're debt-free, or should you move forward and buy now? Making the wrong choice could cost you thousands. In this video, I'll break it all down so you can make the right move and get the best deal on your mortgage. Debt isn't the only thing that determines if you qualify for a mortgage. There's also your credit score. Your credit score influences the mortgage interest rate and loan approval. The kind of debt you have can affect your credit score. You want to have a higher credit score because that can help you qualify for the loan and also get the best terms and lowest interest rates. You also want to have savings and cash reserves. Lenders want to see money available for closing costs and emergencies. You also want to have a stable income and employment history. A steady paycheck matters more than being completely debt-free. Then there's your debt-to-income ratio, or DTI. This determines how much debt you carry compared to your income. Let's go over some of the types of debt and how they affect your loan eligibility. First, there's revolving debt, like credit cards. Your monthly required payment is what factors into your DTI. Paying off credit cards before applying for a loan can significantly improve your mortgage terms. It lowers your DTI and then can increase your credit score because your credit utilization goes down. You want to keep your credit utilization at least below 30%. However, if you have a 10% or lower, you can get the best terms and rates. Then there are also installment loans like car loans, student loans, and personal loans. As I mentioned before, monthly payments factor into how much home you can afford because of your DTI. Lenders may allow certain deferred student loans to be excluded from your DTI calculations. You might want to ask around a little bit since each lender is different. If you're trying to get a mortgage, don't just settle for the first lender you talk to. Each lender has different guidelines for handling debt, student loans, and credit scores. Talk to at least 3 lenders, compare loan terms, and ask these questions. Do you require collections to be paid before closing? How do you handle student loans in DTI calculations? What's the minimum credit score for your best rates? Doing this could save you thousands in interest and fees over the life of your loan. Not all debt is treated equally by lenders. Credit card debt, revolving debt, is weighed more heavily than installment debt, like car or student loans, because credit cards fluctuate and can increase at any time. Meanwhile, a fixed car loan or student loan has a set repayment term, making it more predictable for lenders. If you have high credit card balances, that should be your priority before buying a home. Then there's medical debt. This usually doesn't impact your credit scores as much, but large unpaid balances can be a red flag. Medical debt may not factor into your DTI. Then there are collections and late payments. These can severely lower your credit score, making mortgage approval harder. Some lenders may require unpaid collections to be settled before closing. So should you pay off your debt before buying a home? I think paying off debt first makes sense if your debt-to-income ratio is too high. Debt-to-income ratio, or DTI, is the percentage of your gross monthly income that goes toward paying debts. Lenders use DTI to assess how much mortgage you can afford. A lower DTI increases your chance of approval and may result in better interest rates. So if your DTI is too high, paying off debt can help you qualify for a larger mortgage. If your DTI is already within limits, saving for a down payment might be a better use of your funds. Sometimes if your DTI is too high, it makes it impossible to qualify for a mortgage. Depending on the mortgage that you're trying to get, your DTI may need to be under 41%, or can be up to 57% with the FHA loan. But there are only certain scenarios where you'd be able to qualify for the FHA loan with a DTI of 57%. You would have to have a lot of savings and typically a higher credit score. So ideally, when you're looking at DTI, you probably want to be in the low 40% range to qualify for most mortgages. It's even better if you're in the 30s. However, with how expensive homes are nowadays, it's really hard to get under 40%. You can go to my website at workwithdang.com for free resources like an affordability calculator and a homebuyer's course. I can help you find a real estate agent in your area. There's more information on my website. If your credit score needs improvement to secure a better interest rate, it might make sense to pay off debt before buying a home. You want to aim for a 740 for the best rates and terms, but if you have a 640 or more, you should be able to get approved for most loans. You just won't have the best rate and terms. If your credit score is under 500, it can be very difficult to get a loan anywhere. If your debt payments are making it hard to save for a down payment or emergency fund, then it might make more sense to pay off your debt first before buying a home. I would challenge you to make a budget if you don't have one already and stick to it. There are some scenarios when keeping some debt is okay, if your credit score is already strong and you qualify for good loan terms. So for instance, let's say you have a 740 or more. Then it might make sense to buy a home and still have some debt. If your DTI is within acceptable lender limits and won't impact your approval, then I think it's fine to buy a home. If paying off debt would deplete your savings and leave you without enough for a down payment or closing costs, then maybe it would make sense to keep some debt. However, I will say that right now isn't the best time to buy a home when you factor in high interest rates and higher home prices, so I don't think you need to rush into anything. However, I know some life events happen where you need to get into a home as soon as possible. In that kind of situation, it may make sense not to pay off your debt if it's going to deplete your savings. But more often than not, I would suggest that if you've got the money to pay off your debt, then it's probably best to do that. Then once you've paid off your debt, you can focus on saving for a down payment and closing costs for a home. If your debts are low interest and manageable loans and it's not affecting your DTI too much, then I think in those cases it's probably fine to keep that debt and buy a home. Ultimately, I think what you want to stay away from is if you have high consumer debt like credit cards. Then I would focus on paying those off before trying to buy a home. Now let's go over some pros and cons of paying off debt before buying a home. A pro of paying off your debt first is a higher credit score. A lower credit utilization can improve your interest rate. You can also get better mortgage terms. A lower DTI may qualify you for a larger loan, and you'll have less financial stress. Fewer monthly payments mean more flexibility in your budget, and there aren't any surprises. Lenders won't require you to pay off debt at the last minute. I've seen that happen before where you're getting close to closing time and a lender's like, oh hey, can you pay off this credit card? And it's like $500 or something like that. And now you're scrambling to make sure that you have that $500 to pay off this credit card, but then still have enough money for closing costs and everything else that goes into buying a new home. Now let's go over some cons of paying off debt first. It delays home ownership. It could take years to pay off debt, especially large student loans. But like I said before, this isn't necessarily the best time to buy a home, so it may not be that big of a deal to delay homeownership. Another con is that it can deplete your savings. Using your savings to pay off debt can leave you without money for closing costs. One big concern people have is that paying off debt first delays homeownership. Here's the thing. The housing market moves in cycles. If home prices are skyrocketing in your area, it might make sense to buy now and manage debt later. Not my preferred method, by the way. But if the market is cooling or stable, taking the time to lower debt can set you up for a better mortgage deal in the long run. Now let's talk about some strategies for managing debt while buying a home. You want to prioritize which debts to pay off first. High interest debt should be your main focus. Pay off credit cards first before lower interest installment loans. You also want to try to reduce your monthly payments. You could consider refinancing or consolidating your debt to lower your DTI. I would caution you on this though. What I've seen some people do is consolidate all of their credit cards, but now their credit cards don't have any money on them, so you can charge even more on them. If you're going to look into credit card consolidation, you want to make sure that you're not adding any more debt to those credit cards. Don't close old accounts. Keeping older credit lines open helps maintain a strong credit score. Let's talk about how you can buy a home with existing debt. You can increase your income. A higher income lowers your DTI ratio and improves your mortgage qualification. You do want to check with your lender how long you would need to have additional income for it to count towards your repayment ability income. So for instance, let's say one of the ways you're thinking about raising your income is by getting a part-time job, but the lender may not consider the part-time job until you've had it for a certain amount of time. You can also explore down payment assistance programs. Some programs help you cover down payments so you can focus on your debt repayment. You could also consider a lower priced home. A starter home with a lower mortgage can make debt more manageable. However, with home prices the way they are, it can sometimes be very difficult to find a lower priced home. With the way the housing market is in most markets, I don't think you need to rush out and buy a home right now. If you have lots of debts, especially credit card debt, I think it makes sense to pay off your debt before you start shopping for a home. However, if you don't have any consumer debt but you have a low student loan payment or manageable car payment, then it might make sense to buy a home if your budget allows. Please like, comment, and subscribe if you've gotten any value from this video. It helps me out a lot.